Anniversary of the Dodd-Frank Wall Street Reform Act. And on this second birthday of sorts, we're joined by Financial Times reporter Shahien Nasiripour. And Mr. Nasiripour, first, describe for us what kind of the biggest impact of the law has been for sort of the average household consumer over the past 2 years.
Sure. Thanks for having me on. I'd say probably the biggest impact, thing that most people can see, most readily, would be the Consumer Financial Protection Bureau. So this is the agency that was solely created to protect borrowers from abusive lenders. And it's the first time there's ever been a federal agency that's been solely dedicated to this purpose. In the past, it was always relegated to bank regulators, and now there's this one agency. And so they're looking at everything from the credit bureaus who produce our credit scores and have our credit histories, to looking at mortgage lending, credit cards, overdraft fees on your bank accounts, student loans, and the rest. That'd probably be the most easy thing to identify for the average household. And
that board that got set up has only been around for about a year now, even though the Wall Street Reform Act is now 2 years old. This is about the first birthday of the Consumer Financial Protection Board?
Exactly. So they were in the Treasury Department for the first year. Now they've been an independent agency. They actually celebrate their birthday today, the 21st.
And they actually recently came down with their first major enforcement action, if I'm correct. Is that right?
That's correct.
And who was that on?
It was against Capital One. It was a joint action with the OCC, which is a bank regulator. Basically, the OCC and this consumer agency, they found that Capital One was engaging in deceptive marketing practices. And so combined, they levied fines and ordered refunds to consumers totaling about $210 million.
So you say the Consumer Financial Protection Board is the biggest impact for the average consumer. What about the impact of this law on the financial system in general? What has been sort of the biggest impact area over the past 2 years?
Well, there's two ways to look at it. You can look at it from the perspective of the average household. So you have various rules and agencies that are designed to ensure that people get loan products that they can afford to repay, that they have an ability to repay, the credit cards and the mortgages that they get. And then that kind of filters up to the banks and then to the overall banking system, where you have rules that are designed to make sure that banks engage in less risky activities, that they're not as connected as they were prior to the crisis, and that they hold more cash aside to guard against unexpected losses. So the way I kind of make it easier for myself to think about it is, you want to protect that borrowers, then you want to protect the banks from making bad decisions, and then you want to protect the overall system so everyone, A, has enough cash set aside to guard against losses, where if one of them were to fail, it wouldn't impact their peers, and also you would make failure less likely because you have more folks holding more cash aside against catastrophes.
Again, Shahien Nasiripour is a reporter for the Financial Times covering these issues. If you want to ask him some questions on this second birthday of the Dodd-Frank Wall Street Reform Act, give us a call on the Democratic line. It's 202-737-0001, the Republican line 202-737-0002, and the Independent line 202-628-0205. So 2 years in, how far along are we in sort of implementing all the different things that the Dodd-Frank Act called for?
It's hard to say. The biggest rules, I guess, from the banking industry's perspective is how much cash they're supposed to set aside to guard against losses. And the reason why that's an issue for them is because the more cash they set aside, essentially the less profit they can generate. That's the easiest way to look at it. But in terms of, if you look at the actual rules and the requirements, there's close to 400 of them that the regulators are supposed to implement. They're about a third of the way through. So much of the law has yet to be actually put in force. But the industry knows it's coming, and so they're starting to moderate their behavior in advance of these rules becoming final. So there's pretty much two ways to look at it.
And a helpful graphic here on this that we found from davispolk.com. The actual act itself was about 848 pages when it was signed into law on July 21st, 2010. But the rules and regulation process to put the act into effect has actually taken about 10 pages of regulations for every 1 page of the law. And so as of today, it's about 8,843 pages of rules and regulations. And like you said, it's
about right.
Only about 30% complete.
Exactly.
What's the biggest part of the act that's still yet to come down in terms of rulemaking and regulations?
God, that's a hard question to answer. Well, there's a lot of rules that have been proposed that have yet to be finalized. From the industry's perspective, there's so much to cover. I guess from the industry's perspective, it would be how much cash they're supposed to set aside. It's called bank capital. How much they're supposed to set aside to guard against unexpected losses. I'd say from the industry, from their perspective, that's probably the biggest remaining issue. But then also for the largest firms on Wall Street, there are all these rules regarding derivatives, which are financial instruments whose value is derived from underlying things like interest rates or mortgages or what have you, where these rules are still coming down the pike and they have yet to be finalized, and the way in which they're implemented will affect the bottom lines for banks ranging from Morgan Stanley and Goldman Sachs to B of A, JP Morgan, and Citigroup. So the most contentious would probably be the Volcker Rule, I'd say.
And explain what the Volcker Rule is.
So the Volcker Rule is this statute, or this part of the law that was called for, which essentially tries to attempts to prohibit banks from engaging in proprietary trading, which essentially is them trading for their own profit as opposed to facilitating trading by their customers. It seeks to prohibit that, as well as large investments in hedge funds and private equity firms. And so folks who are pushing for a more, radical reform of Wall Street, they wanted to have the banks separate out their investment banking units from their retail deposit taking units. So if you take deposits and you have access to kind of a taxpayer guarantee, then you shouldn't be engaged in so-called risky activities on Wall Street. Folks couldn't get that. They instead got the Volcker Rule. It's the next best thing. And this is probably the most contentious part of the law right now.
And how close is the Volcker Rule to actually being implemented? It was supposed to be implemented by today, correct?
Right. It's not close at all. The Federal Reserve a couple months ago, or several weeks ago, essentially told the industry that because we don't have a final rule in place yet, you have another 2 years to comply. And so the industry essentially has to convince regulators that it's doing its best to get ready so that when the rule is final, that they will be in compliance, but the party's still on for another 2 years.
Again, we're talking with Financial Times financial and regulatory correspondent Shahien Nasiripour. We'll go now to Buffalo, New York. Carl is waiting on the Democratic line with a question on this 2-year anniversary of Dodd-Frank.
Yes, we know from previous studies that regulators and investigators for example, the Securities and Exchange Commission, many of them end up taking a very cushy, much higher paying job on Wall Street with banks and so forth. So my question is, under this newer Dodd-Frank law, is there any requirement built in the law or the proposed regulations you see coming that would ban the regulators or investigators of this organization from accepting for 2 or 3 or 5 years cushy, higher-paying jobs on Wall Street? If it's not built in there, should it be?
Well, thanks for the question. There's nothing, to my knowledge, there's nothing in Dodd-Frank that attempts to restrict employment for government regulators and officials after their time is served, or after they've served their time in the government. I know some of the agencies do have rules which essentially try to institute a cooling off period for some of their officials where, for example, if you work on a particular issue involving a particular bank, you can't work for that bank for, until a year after your term in the government has expired.
This is the same sort of idea that they did with lawmakers and lobbying?
It's essentially the same thing. So a lot of the agencies have, similar rules in place. But if someone from the SEC wants to go work for Goldman Sachs tomorrow, there's really not too much of a restriction on that kind of activity. Whether it should be, that's a good question. It's hard to say. At what point do you try to restrict an individual's ability to gain employment? If someone's in the government and they're making, let's say, $120 a year, it's a comfortable living. But if they have 3 kids who are going to college and they're tired of working for the government, if they want something maybe more exciting or something more comfortable, where do you draw the line in terms of restricting their options? So it's a tough question for me to answer. I really don't have an opinion on it.
Let's go to Aaron waiting on the independent line from Portland, Oregon this morning. Aaron, you're on with Shahien Nasiripour this morning.
Yeah, hi, good morning.
Hi.
One of the things that, and I wanted to get your comments on this, is, you look at Alan Greenspan and his laissez-faire policies and derivatives and his view on them, and Brooksley Born, and, she was at the CFPB, and multiple warnings to Greenspan and his crew. And then you have this meltdown, and now we're into this heavy regulation. So, you go from Greenspan and laissez-faire, oops, and then heavy regulation, and I wanted to get your comments on your thoughts on this.
It depends on how you define heavy regulation. I mean, some would argue that there was very little regulation in the years leading up to the crisis, and the rules that were in place weren't properly enforced. I mean, there is an argument to be made that since the meltdown, or near meltdown of the financial system, that the regulators have taken kind of an overly restrictive approach in which they convince lawmakers to add rules upon rules and give them more authority to police the financial system. It depends on your perspective. If you were previously underregulated or unregulated, obviously the new regime is not going to work in your favor. But if you were a bank that was subjected to various banking rules and various banking laws, and you had regulators stationed in your bank, and you were competing with other financial firms that weren't as heavily regulated, from your perspective, the new regime may be a good thing because it attempts to put everyone on an equal playing field, so no one can try to skirt the rules and offer products that are cheaper or less regulated, and essentially try to put you out of business. So it depends on your definition of what constitutes heavy regulation.
A question from Robert Pacheco on Twitter this morning: why not just reinstate Glass-Steagall? To tack on regs is a waste of time, as Wall Street will always find ways around. And explain Glass-Steagall as you answer that.
I mean, it's a fair point. So Glass-Steagall was this Depression-era law which sought to essentially forbid, regular, Main Street retail, deposit-taking banks from investment activities. So, for example, the best way I can describe it right now is you take Bank of America. Bank of America absorbed Merrill Lynch during the crisis, which was an investment bank. If you were to bring back Glass-Steagall, you'd have to cleave off Merrill Lynch from B of A. And B of A can no longer engage in what would be defined as Wall Street activities. They can only really make loans and take deposits. It's a fair point to ask, or it's a fair question to raise in terms of whether we would need that kind of, whether it's better to have that kind of system and then get rid of all these other rules versus the current regime that we're in. Now, Congress had the opportunity to do this during the Dodd-Frank debate. In the spring of 2010, two senators, Sherrod Brown from Ohio and Ted Kaufman of Delaware, who's no longer in office, they were both pushing this provision, which essentially would have forced the largest banks to break up because they were getting, in their view, too big for the system overall. Now, that provision failed in the Senate. At this point, I just don't see Congress taking this up. I mean, the banks are the size that they are. Regulators hope that they will shrink in time due to the influx of rules that are coming into place and higher capital requirements and the rest. And regulators sincerely believe that the largest institutions will eventually shrink. But in terms of forcibly breaking them up, I just don't know if that's really going to happen.
You talk about Congress's reaction to the Dodd-Frank bill. 2 years in, we've instituted about 30% of what Dodd-Frank called for. What has been the response from members of Congress? Are there still folks trying to stall this or even repeal it?
Yeah, the entire Republican Party is trying to stall it or repeal it. I mean, I think the general consensus is on the Republican side of the aisle is that Dodd-Frank was the wrong solution for the problem that faced the financial system in the country. You can look at it a variety of ways. It's either too much government involvement in an industry, or it's too much regulation at a time when the economy is still weak, and layering on all these different rules and requirements could impede credit and lending, which, if anyone has tried to get a mortgage recently or try to get a loan for a small business, they know it's really hard to get a loan right now. And from folks who are critics of Dodd-Frank, they blame the law, saying that this is making lenders reticent to lend money. On the Democratic side of the aisle, they look at Dodd-Frank not as Dodd-Frank, but as Wall Street reform, and it's their answer to, the wild times on Wall Street that produced, the most punishing crisis, or most punishing recession since the Great Depression. And so they have polling data which suggests that the law is overwhelmingly popular with the average household, that this Consumer Bureau is overwhelmingly popular, with average households. And from their point of view, if you think of the last few years, they've got the healthcare law and this so-called Wall Street reform law. Those are their two biggest legislative accomplishments, and they're reticent to, not stand behind it.
A release from Chairman Spencer Bachus, the Republican head of the Financial Service Committee in the House, on the 2-year anniversary of the Dodd-Frank Act. When President Obama signed Dodd-Frank into law 2 years ago, he promised it would provide certainty to everyone from bankers to farmers to business owners to consumers. Today we look at the sad shape of our economy and realize Dodd-Frank has had precisely the opposite effect. Supporters of Dodd-Frank sold it as Wall Street reform, but as our committee has learned from listening to hundreds of witnesses, it is Main Street that is getting crushed under the law's 400 new rules and mandates. The layers of red tape Dodd-Frank piles on our economy causes more uncertainty for American businesses and hinder their ability to grow and create jobs. That again was Spencer Bachus on this second anniversary of the Dodd-Frank Act. I want to show you a bit of Consumer Financial Protection Bureau Deputy Director Raj Date talking a little bit about the criticism his agency has received.
Sometimes lost, and perhaps it's my own fault for not being as clear about this as maybe I can be. The CFPB does not supervise or enforce the law with respect to small banks. There are 15,000 banks, thrifts, and credit unions within the country. Our supervision authority extends to, call it, the biggest 105 out of 15,000. Second, are any putative sort of burden associated with abiding by regulations that are promulgated by the CFPB. Although conceptually I understand that notion, the fact of the matter is that we have finalized two substantive rulemakings since being in business for a year, one of which by its terms kept in place the status quo. That's the Alternative Mortgage Parity Transactions Act rulemaking. And the other is not yet effective, and indeed we have publicly said we are considering means by which to provide exemptions for smaller providers. So the burden argument with respect to smaller institutions, I think we've been quite attentive to.
So that was Raj Date talking about the CFPB. We talked about some of the folks who are against this. Is there actually a chance that the CFPB could be dismantled or Dodd-Frank could be repealed? I mean, is that a possibility that's still on the table?
Absolutely. If Mitt Romney wins the presidency and the Republicans hold the House and they take the Senate, yeah, it's tough to. I mean, I say absolutely, and now on second thought, I'm not so sure. There are elements of Dodd-Frank which are popular. So in terms of, there's a lot of noise about dismantling the CFPB. Whether that actually, if people follow through on that, I have doubts. I think what may end up happening is they'll just try to put more checks on the CFPB and try to weaken its authority and weaken its power and make it more subject to the will of Congress. So taking away, for example, its independent funding stream from the Fed. I could see that happen. I see that as being a more likely possibility than dismantling the agency altogether.
Let's go to Austin, Texas. Gary is on the Republican line this morning. Thanks for waiting, Gary.
My question is, will this new law prevent homeowners from using their house like an ATM machine? Thank you.
That's a good question. I can't think of anything in this law that would prevent folks from taking out, home equity lines of credit on their house and, using it like an ATM machine. I know that it does make banks kind of think twice about lending money to folks in terms of there are now heightened requirements. There are more things that they have to keep in mind. They have to make sure that the borrowers have an ability to repay all the loans that they take out. But if someone has good credit and if they can afford the loans and they can afford to take equity out of their house, I can't think of anything in the law that would prevent that.
A question on Twitter from Daniel Yount. Does the Dodd-Frank Act stop does the Dodd-Frank Act stop in any way from investment banks putting low-risk investments, AAA, into very high-risk investments?
I don't know, to be honest. I can't think of anything that would restrict that. I mean, Dodd-Frank, what it does do is it essentially deletes any references to credit ratings in banking rules, banking laws. And so you could see a regime in which so-called AAA is no longer means what it says. And so perhaps I could see something where some kind of similar activity continues to take place and there's no restrictions on it. But I can't think of anything off the top of my head.
Again, we're talking with Shahien Nasiripour of the Financial Times. How long have you been at the Financial Times?
About under a year, so I think about 9 months or so.
And what were you covering before that?
I was at the Huffington Post, and I was covering essentially the same issues.
Financial issues?
Correct.
And before that?
Before that, I was at the Center for Investigative Reporting, which is a nonprofit investigative newsroom out of Berkeley, California. So I was there for about a year and a half.
We'll go to Hammond, Oregon now. Ted is on the Democratic line. Ted, you're on with Mr. Nasiripour.
Good morning. I have been just an observer of this downturn since 2008. I've never cared about a FICO score. I've never had a loan. With me, cash is king. And as far as Glass-Steagall, that was a 34-page document that worked flawlessly for 70 years until the repeal by the architect, Senator Phil Gramm from Texas, a fine Republican. And with this, we've got 2,000 pages of Dodd-Frank, which does not seem to want to be applied to Wall Street, the bankers, to the money changers that were the architects of this downturn. I just want to know the difference between Dodd-Frank and Glass-Steagall, why we can't bring that document back. Thank you.
It's a good question. I guess the easiest way I can describe it is Glass-Steagall at the time, you could kind of define it, look at it as like a meat cleaver, in which it just sought out to separate, essentially a bank's access to a taxpayer safety net or guarantee. Separate risky activities away from that. So if you want to engage in trading or various types of other so-called risk-laden activities on Wall Street, you wouldn't have access to the kind of taxpayer safety net. And because of that, the thinking goes, you would think twice about taking extreme risks because no one would bail you out. Dodd-Frank, on the other hand, didn't take that approach. It was more of a scalpel in which they tried to limit certain activities and try to curb others and just put more rules and requirements on banks to incentivize them not to take these humongous risks. Whether it works or not, I mean, people are split. It's tough to say why lawmakers went for this approach as opposed to a more simplified approach. I don't have the answer to that.
A couple comments on Twitter. Michael Langweiser writes in, Dodd-Frank is a jobs program. Look at all the lawyers that will be needed to understand 1,000 pages of rules. And one other one on Twitter from Obama Games, Wall Street is a complete fraud. How can you regulate a complete fraud? That would be silly. We'll go back to the phones. Atlanta, Georgia. Haywood's on the independent line. Haywood, you're on with Mr. Nasiripour.
Yes, my question is, as far as the Job Act that passed that allows hedge funds to be able to advertise to accredited investors, is there anything in the Volcker Rule that addresses hedge funds as far as the content and the form of advertising for hedge funds to accredited investors?
I don't believe there's anything in the Volcker Rule that would limit such, or that places any kind of restrictions on advertisements to accredited investors. What you're referring to is part of the Jobs Act, which was just passed recently, overwhelmingly in the House, and was signed by the President into law. What that sought to do is make it easier for businesses to raise capital. And one of the provisions in the Jobs Act allows for hedge funds to advertise to accredited investors, whereas before they were restricted in how they could advertise their funds. there's really nothing in the Volcker rule that places any kind of limitations on what kind of advertisements they can make.
And as I understand it, was advertising that Citibank was doing that got them caught up by the Consumer Financial Protection Board. Is that right? Some of their credit card advertising?
Capital One.
Capital One. I'm
right.
sorry about
yes.
that.
It was more. Yeah, it was along the lines of like their payment protection plans, various credit monitoring. I mean, it was their marketing practices that were deemed, unfair and deceptive, and that's what tripped them up.
So did they acknowledge that wrongdoing in this case, or what was the outcome? They were just fined?
They were fined. They agreed to refund consumers and make them whole. They apologized for bad behavior. Whether they admitted fault, I don't recall, to be honest. But I do remember them apologizing and pledging to reform their practices.
And what is this costing Citibank to make this right?
Capital One.
Capital One.
It's $210 million. The interesting thing in this enforcement action is any consumer who was harmed is going to get a full refund, where, for various other settlements that are reached with financial institutions, those who are harmed, they don't always get their entire money back. But in this case, everyone will. So that's a change.
Let's go to Los Altos, California. Mike is on the Republican line. You're on the Washington Journal this morning, Mike.
Okay, thank you for taking my call. I wanted to ask you a question. We had a caller a few moments back who said Phil Graham was responsible for removing the Graham-Spiegel protection for the consumer. And it turns out that also Bill Clinton and, ironically, Dodd and Frank were also involved in this. How come they're allowed to help destroy the system and then allowed to make laws later that protect it? I think it's really tragic. And when I look at it, it's a disgrace. They're, to me, the people who are really responsible for opening the chicken coop up to the foxes, and they get a free pass on this. Could you please comment on that?
Sure, it's a fair criticism to raise. A lot of the folks, well, as you just described, Glass-Steagall was it was nullified essentially by an act of Congress and signed by the president. And the president at the time was President Bill Clinton. And some of the folks who were the most ardent champions of repealing Glass-Steagall were folks like Larry Summers, who then became President Obama's first. He was the head of the National Economic Council in the Obama White House, and other folks who are at the Treasury Department now were also, involved in the Clinton administration back then. And so, this did come up, a few years ago when Dodd-Frank was kind of gearing up and those deliberations were happening, where you had officials who had pushed to deregulate the system were now in positions of authority in which they were, pushing for reforms that would re-regulate the system. It's a fair question to raise. In terms of my opinion on it, people's minds change. They learn from experiences. It's hard for me to judge, whether or not someone is particularly able or has any kind of credibility with respect to the positions that they're pushing. I can only trust that they're doing the right thing.
Joseph asks on Twitter, Mr. Nasiripour, did not having Dodd-Frank lead to the financial collapse of 2007?
That's a good question. I don't know, to be honest. I mean, I think there's a fair point to be raised in which if the regulators were properly enforcing the laws that were on the books, that perhaps they could have curbed the worst of the activities that eventually did lead to the near collapse of the financial system. And if regulators and the Treasury Department and the Fed were more proactive early on in the crisis, that we wouldn't have experienced, the worst of it later on. If Dodd-Frank was in place, would all of this been avoided? I think the administration believes so. And I think they say so publicly. I don't know if I think that's the case, though.
And for those who were pushing Dodd-Frank after the collapse 2 years on, are they satisfied, or do they feel like they should have asked for more? I mean, where is Dodd and Chris Dodd and Barney Frank today on their act?
Barney Frank's very proud of Dodd-Frank. He has since said that there are some provisions in there he wish he would have pushed harder for and beefing them up. There are others in which he has said that lawmakers got it wrong and that regulators need to moderate it. Mr. Dodd has since left the Senate, and he's now working for oh man, it's the Motion Picture Association, I believe, if I'm not mistaken. I think he's still a champion of his law. You know, the administration still supports it, and they're still very sensitive to criticisms of Dodd-Frank in terms of, you know, whether it restricts access to credit or whether it, you know, creates uncertainty, or even from the left, whether, you know, it's even tough enough. They're very sensitive to that, and so they're very ardent champions of the law.
You ask about, or you talk about criticism about whether it's tough enough. Sheila Bair is the former chair of the Federal Deposit Insurance Corporation and the current chair of the Systemic Risk Council, which is a nonpartisan group monitoring and encouraging regulatory reform. She wrote in to Yahoo News a column this past week. She writes at the end of that column, "We need regulators to write rules that the public can understand and the examiners can enforce. They need to stop rising to the bait when lobbyists come in seeking special interest provisions. They need to work together to prioritize, coordinate, and finalize cohesive and effective rules that are targeted on the lingering problems in our financial system, and Congress needs to support them. It's time to stop timidly working around the edges and get the job done." We'll go to Jacksonville, Florida now. Bob is on the Democratic line. Good morning, Bob.
Good morning. I would like for you gentlemen to address my question or my statement about banks should go back to banking and not deal in equities or day trading. If they want to deal in the stock market, let them do it at long-term capital gains, 2 years term. This day trading is a heyday with banks. It's just an absolute sin. And if I were a banker, I'd be having a heyday too. So they need to put banks back to banking and let brokerage firms deal in equities, stocks. Bonds, fine with banks. But they're having a heyday with the stock market, and that's a horrible, horrible result will be. What do you think? Thank you very much.
Well, if I'm not mistaken, I think the data shows that most of, trading in equities isn't conducted necessarily by the big dealer banks. It's by these small firms that are set up simply to day trade and try to find price distortions. And long story short, it's pretty much these specialized firms that do a lot of the day trading as opposed to the banks. But there is an argument to be made that banks should just be banks, and if you want to be an investment firm, you shouldn't have access to kind of the taxpayer subsidy or to a safety net. And there are folks in government who feel that way. One of the members of the board of directors of the Federal Deposit Insurance Corporation, Tom Honig, who prior to this was head of the Kansas City Fed, he has believed for years that banks should be banks, that he believes in a modern-day Glass-Steagall, that if you want to engage in investment activities, if you want to be a player on Wall Street, you shouldn't have access to the Fed's discount window, and you shouldn't be able to accept deposits from folks and have deposit insurance. You should be completely on your own. And if you're a bank and you have access to the taxpayer safety net, you shouldn't be engaged in these kinds of risky activities. So you're definitely not alone in feeling that way.
A couple comments on this 2-year anniversary of Dodd-Frank on our Twitter feed today. Laura Zahner writes in, "Dodd-Frank is just like its namesakes, overblown, verbose, and useless." And one other comment from James on Twitter this morning, "The bankers own the politicians. There is no stopping them anymore." We'll go to Weston, Florida. Thomas is on the Independent line.
Yes, how are you today?
Good. Go ahead, Thomas. What's your question?
Just comments. I spent over a decade as a compliance officer in banking, so I'm very intimately familiar with the topic that we're talking about today. And we can talk all we want about, Tier 1 risk-based capital ratios and all that. But let's get to brass tacks here. Our early call mentioned Graham Leach-Bliley, or at least intimated about Graham Leach-Bliley, and I found it very interesting that Dodd-Frank, the one thing that wasn't cut off was the connection between banks and insurance companies. Just one point that I had. And another thing in regards to whether or not Dodd-Frank would have prevented the crisis, the mortgage lending crisis. I think a big problem with that was the actual mortgage fraud that was actually going on, especially in the subprime lending. I don't think it was a secret. In fact, I remember very vividly back in probably 2003, 2004, people were worried about Fannie Mae and Freddie Mac. Even if the fact that they were government-sponsored enterprises, which of course has changed a bit now.
Well, let's give Mr. Nasiripour a chance to comment.
I'm not sure what the question is.
I just wanted to give you a chance to jump in on his statement, if you wanted to, about Fannie Mae and Freddie Mac.
Sure. I mean, it's a fair point. Dodd-Frank doesn't really address Fannie Mae and Freddie Mac, and they're still wards of the state, and there's no plan of exit at the moment. And prior to the crisis, they had an implicit government guarantee. Everyone who bought stock in Fannie Mae and Freddie Mac thought it would continually go up. Anyone who bought their debt assumed that they would be, they'd be made whole in case they ever fell into trouble. So there was really no restrictions on Fannie's and Freddie's activities, and they had a lot of influence in Washington. I mean, it's changed since then, but at the time they were able to essentially engage in whatever activities they wanted. Now there are curbs on that, but at the end of the day, they're still wards of the state, and there's no exit in sight.
On this second anniversary of Dodd-Frank, the Boston Globe notes that only 120 of the 398 regulations enumerated by the law are actually in effect today. Is it going to take another 2 years before we get to that 398, or how long do you think it's going to take for all of those laws to finally go into effect?
I mean, it could take a couple more years. That's absolutely right. There are deadlines for a lot of these rules, but at the end of the day, the regulators can push those deadlines and extend past them. And given how so many of the rules are very contentious, and it requires all the regulators to be on the same page, and these regulators have different interests, they're concerned about different things, it's not as easy to reach consensus. It could very well take another couple of years before all these rules are finally in effect.
And should note that the Washington Journal back in June did a series on the financial institutions and financial agencies, some of those that were actually created by this law, including the Consumer Financial Protection Bureau. You can find that all online at cspan.org and search our video library. In the few minutes we have, Lex, we'll go with Carol from Tempe, Arizona on the Republican line. Good morning, Carol.
Yes, good morning. Thank you for this subject. I'm a small business owner, and I have a son-in-law that's has a dentist company. And let me tell you something, as soon as this went into effect, the money freeze for small businesses just literally got cut off. And then you guys are talking about Fannie Mae and Freddie Mac. Well, isn't it amazing? I watched this on on CNN constantly. They kept saying the Republicans wanted them to do something about Fannie Mae and Freddie Mac. And Senator Dodd, one of little Angelo's friends, he goes, that would just be too hard. And Barney Frank didn't want it either because he's the one that pushed all this. So here's the thing that got us into it, and those two slimes wouldn't do anything about it. And the other thing is, how can they do anything about it? Senator Dodd got his daddy's job. How young was he? He's been sucking out the federal government. The vice president has been a senator since he's 29. The presidents, they don't get it. They don't know how the economy works. And these are the guys in charge, just like Nancy Pelosi and Harry Reid, screaming for Romney's tax records. Show us yours. And she says, well, that's a different thing. Well, yeah, she gets to be one of the first for IPOs and all these other things that go into effect. This is Senate and the government that we need to see their tax records. These are the people making these laws, just like these laws in the health care. Their staffers end up putting what's going in them. Nobody, when they passed, they did not know what's going to Dodd-Frank.
Well, Mr. Nasiripour, talk about some of the criticism that has come down on Mr. Dodd and Mr. Frank in the 2 years since this law has actually gone into effect.
Wow, where do I begin? Well, Senator Dodd was a longtime member of the Senate Banking Committee. He was, part of the group that did push for, to try to deregulate Wall Street and free up capital. In hindsight, he, whether that was a good idea at the time or not remains to be seen. It's not for me to answer. Congressman Frank, he has come under severe criticism by Republicans who argue that when there was an opportunity to curb Fannie and Freddie, he was among the company's most ardent champions. It's a little bit unfair, only because it wasn't just Democrats who were supporting Fannie and Freddie during their heyday. It was also the Republicans, and it was also the Bush administration, the Clinton administration. Yes, there were folks who had concerns, but the truth of the matter is no one in this town really had enough juice to curb Fannie and Freddie. I mean, that's just the bottom line. Whether Democrat or Republican, just no one had the authority, or excuse me, no one had the power to do it. That's the bottom line. And with respect to our first criticism of small businesses getting access to credit, there is an argument to be made, over whether or not Dodd-Frank does restrict lending. But I think it may have something more to do with the general economy. And as opposed to looking at the rules that are coming down the pike, I think folks need to be mindful of, banks are hesitant to lend because a lot of them aren't as in good shape. Interest rates are supremely low, and if they have to make sure that if they're going to make a loan now at, let's say, 3-4%, when interest rates invariably rise, what kind of position is that going to put them in? And so there's a lot of different factors. It's not just Dodd-Frank, it's the economy.
One last comment on Twitter from Fies Guy writes in, Dodd-Frank was the best law Congress could muster given the heavy influence of big banks on the GOP. And one last note from that Boston Globe story that we mentioned earlier, Barney Frank, who is retiring from Congress at the end of the year, will spend his final months in Washington defending his namesake law and protecting funding for those regulatory agencies, writing the rules and overseeing the firms. He told the Boston Globe, there's this egregious effort to kill it by not funding them, Frank said, referencing in particular potential cuts to the Commodity Futures Trading Commission and the SEC. That story, again, is in the Boston Globe if you'd like to read more from July 16th. Want to thank you for coming in to talk about Barney Frank and Chris Dodd and their legislation on the 2nd anniversary. Appreciate it.
Thanks for having me.